All yours.
All right, that's so welcome to Odyssey Advisors presenting how to understand asset allocation. My name is Curtis Thompson. I'm one of the actuaries here at Odyssey Advisors. This is actually a presentation that I was able to do internally here for our team. Every year we go off location for a couple days and do some internal training type stuff. And I have somewhat of a background, not only in being an actuary, but have a background in finance as well. And so I was able to explain asset allocation. And what we are looking at as actuaries generally is asset allocation on your pension and OPEB plans. And so what we're going to do today is walk through an exhibit that if you've ever looked at a pension report or an OPEB report, you've probably seen before. And try to understand what, as actuaries, we are doing with asset allocation, how to understand some of the basics of asset allocation, what different asset classes are, how they behave, the different expected return that we see on various asset classes. So what you'll see on this first slide is probably very similar to what you have seen if you've ever looked at an actuarial valuation and looked for the expected long-term return. And so we have here various asset classes, and essentially what we're going to do today is walk through these various asset classes and talk through what they are, what they mean, and certain behavioral characteristics of the type of risk, the type of return that you might be able to expect in these various asset classes. One thing that I want to point out right from the beginning, so we say here expected return on assets, and then it says building block approach. And so some people who have some background in investments, you might look here all the way to the right. We have our expected long-term rate of return for all kinds of different assets, and you might say that seems really low, like those numbers don't seem high enough. And what a building block approach, and what every actuary is going to do on a retirement or OPEB valuation is use a building block approach. And essentially what that means is we take inflation out of the total return that we expect. So when we look at that first line, our domestic equity is 4.1%. That's after inflation. So if we add inflation back in, that really means that it's expecting 6.6%. So that's just one thing to understand as we go through and we look at the expected return on some of these assets. You might see this looking lower than what you would normally think. And that's because we've stripped the inflation out and then we add it back in at the end so that it ends up even and consistent for everything. So we're going to walk through this chart, asset class by asset class. The first thing we wanted to do was start with just some basic terminology and understanding some basic language that we're going to use. So the first thing that you'll see, we have domestic equity and we have international equity. And so what does equity mean? So when we say equity, we're talking about common stock. You might also hear people say shares. What we have here is it says that you're entitled to a share of future profits. So equity, common stock, shares are all a reference to owning a company. And often we don't necessarily think that way because it's all digits on a screen and you're buying, a mutual fund, or you're buying, you never actually feel like you own the company. But that's what stock is. It's the ownership of all of the future profits of a company and all of the current assets of a company. The opposite side, when we talk about fixed income, in general, we're talking about bonds. And a bond is a debt instrument. So you would buy the debt instrument, and what's going to happen on a bond is you have coupon payment that happens periodically, usually twice per year. And twice per year over the course of the term of the bond, you're going to get a small payment of interest. And then at the end of the bond, you get back the entire face value, the entire amount that you invested. And so that's why it's called a fixed income, because when you buy that bond, every 6 months or so, you're going to get a set payment, and that payment doesn't normally change. And so these are, main categories we're going to walk through, and then we're going to get into a little bit of the alternatives as well. So just another basic terminology thing, but this slide says, why is equity capped? And for those of you who haven't picked up on it yet, when we looked at that first asset allocation, that first building block approach, we said domestic equity, large cap. And then the next item was domestic equity, mid cap, small cap. And so some people, this might seem obvious, but I've had conversations with people who have asked me this question, like, why would equity be capped? Like, is there a maximum amount that I can earn? And no, that is not what market cap means. Cap stands for capitalization. And what market capitalization is taking the number of common shares of a company, multiply that by the market value of those shares, and you would get the total value of that company on the stock market. So for example, Coca-Cola, KO, that's their stock symbol. They have about 4.3 billion shares outstanding. And the price fluctuates all the time, but it's, let's say it's right around $60 right now. And so that would mean the total market capitalization is 4.3 billion times 60. So $260 billion is the market cap. So we're not talking about a maximum amount that these stocks can go to. We're just talking about their total value of these companies. So anytime you hear someone's talking about cap when they're talking about equity, that's what they're talking about. So now moving into our first category, domestic equity, large cap. So what is a large cap stock? Essentially, large cap stocks, and if you ask different people, different brokerage firms, different investment advisors, you're going to get all different answers on what the floor is, what the minimum value for a large cap stock is. But in general, about $10 billion is what people are going to say. Anything larger than that, you could consider a large cap stock. So we already talked about Coca-Cola, right? $260 billion. But a lot of other large cap stocks that you might know, and a lot of large cap companies are going to be companies that you recognize because these are big companies, they're brand names, they're products that if you haven't used it before, you've probably seen it before, or at least heard of it before for most consumer products. And so things that you might know, Apple, Microsoft, Amazon, Coca-Cola, we could go on with a long list of these things. These are big, large companies that have operations all over the country, all over the world. And so some of the characteristics of owning a piece of a big, large company, well, their earnings are going to tend to be more stable. So you think about a smaller company, they might have bigger swings in earnings. So they might have a quarter where their earnings are up, several percentage points from expected, and a quarter where their earnings are down several percentage points from expected. Whereas large cap companies, that still happens, but that fluctuation up and down tends to be a little bit less. And a part of what you're going to get is more stable returns. You'll usually, or often in large cap companies, you might get a dividend. So there's going to be some stability in the return that you get. There's also tends to be a characteristic of large cap stocks is that there's somewhat less room for growth. So if we stick with the example of Coca-Cola, everybody knows Coca-Cola. Their marketing isn't really, getting new people to discover this product that nobody's ever heard of before. People know Coca-Cola, and there's not a lot of markets that they haven't reached. Coca-Cola is all over the world. And so there's not as much room for them to grow. There's not as much untapped market for them to introduce their product to and have it really take off. Whereas for a smaller company, there might be more room for those things to happen. Another characteristic that you're going to see on almost all large cap companies is they're going to be probably at least nationwide. They're going to be everywhere in America. You can get these products, or someone could work for one of these companies and be located in all kinds of different states all over the country. But not only that, a lot of these companies' operations are international. So this gives a little bit of built-in diversification to these stocks. because, if the market in Europe is not doing so well right now, well, the market in America might be doing all right. And, if both those markets are kind of, faltering, then there might be growth happening in Africa or Asia, or, they have operations all over the place. So that is part of what helps them stabilize their earnings. Part of what this also introduces is a little bit of, international risk of there's a built-in element in some of these stocks of the currency risk, they're being paid in foreign currencies, and they've got to turn those back into dollars. So those are some of the characteristics that we see in a large cap stock. So you see at the bottom of the screen here, our expected return on large cap stocks is 4.1%. So it's respectable. It's nothing, it's not going to make you rich overnight, but it is a respectable return that we expect from large cap stocks. Then we move to mid cap stocks. What you're going to see is the market capitalization on mid cap stocks is a little bit lower. And so the market cap is between $2 and $10 billion. And again, those numbers are variable. You might talk to one asset advisor and they'll say that, that goes up to $20 billion. And, you might talk to another who says, like I like more like $7 or $8 billion. The numbers themselves aren't set in stone, but the idea is these companies are large companies, but they're not these huge mega companies like the large cap stocks are, but they're still, a lot of them can still tend to be household names. And so more examples of names that you might know: Yeti, Hostess Brands, Harley Davidson, BJ's, Whole Food Clubs, Crocs, World Wrestling Entertainment, Texas Roadhouse. Most people, we've heard of these things. Even if we've never bought their products, we know that they exist. So some characteristics of these compared to the large cap stocks, their earnings are going to be a little bit more volatile. And so I've showed a number here that's beta. For those that are not, financial people, beta is a term that measures the variability of a stock compared to generally the S&P 500, but it's the variability of a stock compared to an index. And so what a beta of 1.08 means is that whenever the S&P 500 moves, this mid-cap stock index is going to move about 8% more. So for example, if the S&P 500 goes up by 1%, the mid-cap index should go up by 1.8%. If the S&P 500 goes down by 1% on average, the mid-cap index will go down by 1.8%. And so you can see, even just in that, right, just a measure of historically how this asset class has performed, there's more volatility, there's more ups and there's more downs. A part of what that means, or a part of what's built into that is potential room for growth. And so unlike some of these mega cap or these large cap companies, they might be able to tap a new market. They might be able to move operations into a new area. They might be able to have a new product that is really innovative, and reaches new and different people. They might be able to get into a different country and see their sales take off from those things. So there's a little bit more opportunity for growth in these companies because they haven't tapped the whole world as a market for themselves yet. And these companies will tend to be larger. They're not small companies. They are less likely to be international though. So they might have nationwide operations, and that's why, most of us have heard of these names, and, Yeti and Hostess and those kind of things. Those are household names. But if you were to go to Europe, maybe not so much. If you're gonna go to South America, probably not gonna see a lot of Yetis going around South America. And so there is a little bit of potential for these companies to move and grow into even having international operations. The next category is small cap, and small cap are, again, even smaller, and the market cap of these companies tends to be 250 million to 3 billion. And so you can already see like that the mid caps, we said 2 billion and it was the top, and now we're saying, or was the bottom, and now we're saying 3 billion is the top. So there's some overlap there between small and mid cap. And again, these numbers are not set in stone. Different asset advisors will have different opinions on what can constitute a small cap, but these are going to tend to be smaller companies. And part of what starts happening when you get into the small cap market is these are not household names anymore. And so even looking through a small cap index, you might be able to look through most of the index without finding a lot of names that you recognize. And so I've pulled just a couple out that most people will recognize: Ethan Allen, the clothing brand, and Winnebago. And some people use Winnebago as a term for any kind of RV, but that's not the case. But we at least have heard the term before. But these companies are not huge, and these companies are not dominating the market. But some of them are doing a fair amount of business, but they can tend to be a more regional thing or a more niche thing. Where if you're really into a certain thing, a brand, and if you're not, you don't. So some characteristics of this asset class. Again, we have even more volatility. So if the beta on our mid cap was 1.08, the beta on the small cap is 1.13. So we again see whenever the S&P 500 moves, on average, these stocks are going to tend to move more. There's potential for some of these stocks to have rapid growth. There's potential for some of these stocks to really, expand into new markets and see their sales really, really rise and see the value of the stock go up with it. There's also more potential in these companies to see a total loss. There's potential that this company has a bad run, or has debt that doesn't work out for them, or a product flops, and the company goes under. There's more risk of that here. Often these are going to tend to be more regional type companies, and so they might not be nationwide. It might not be something that you can get everywhere. It might be a Northeast thing, and that's why we know Ethan Allen, because it's a Northeast thing. It might be a little bit more of a niche thing, and so there's a little bit more opportunity for some of these companies to grow even within the United States, to grow their operations from one region to another. And so, going down to the bottom of the screen, you see that domestic equity, our small and mid cap. When we put this on your OPEB or pension valuation, small and mid cap get combined, and we have an average return or expected return of 4.55%. Now, one thing that's interesting to look at is if we were to take a small and mid cap beta and put them together, and we might be about a beta of 10%. And if you look at that 4.1 to that 4.5% return, the difference is about 10%. And so, there's a relationship there between the expected risk goes up and the expected return goes up. And you can kind of see that if you understand the beta a little bit, and hopefully, maybe that helps some people have these things, risk and return, click into place. The next asset class that we're going to look at is international equity. So these are companies that might not trade on the U.S. stock markets. It's a company that is headquartered in a different part of the world. And we're looking at international equity, and the first category is developed markets. And so examples of developed markets: England, Ireland, Australia, Germany, France, Japan. These are companies where their economies are pretty developed, and there's opportunities to invest in companies, and their stock markets look very similar to U.S. stock markets. Some characteristics of these developed markets is they have low social or political risk. And so as we start looking at some of the developing markets, and you could even go into frontier markets, there tends to be more of that social risk, more risk, that there will be big changes to the political structure, or like big changes to the social dynamic that can really hurt a company's bottom line. These developed economies have a lower risk of that. One thing that you by definition introduce as soon as you start investing in developed markets is currency exchange risk. So all of these markets, you're going to be, let's say you're investing in a company in England, you're going to have to turn your dollars into pounds to invest in that company. That company's income is all going to be generated in a foreign currency for us in America. And then if we want to pull our money out, we have to then pull it out in pounds, change it back into dollars. And so that currency exchange risk, or where the current or how strong relatively those currencies are, will affect the total return that we get on those investments. Another characteristic, and part of the reason why we invest in developed markets is that there's a lower correlation to US companies. And so, if the economy in the US is struggling, then some of these companies might be doing better, and it helps stabilize their return on our portfolio. So we have fewer extreme ups and downs. So the next category we're going to look at is emerging markets, and emerging markets tend to be not fully developed. Some people might call these developing markets. They have some opportunity there because they could have this place where more stability happens, but they're not quite there yet in terms of economic stability. Some countries that would be categorized as emerging markets or developing markets: Brazil, Turkey, China, India, South Africa. These are countries that they're still financial markets. Saudi Arabia has been opening up a lot of their markets, and you can still invest in their financial markets. But there's a little bit more expected volatility. There's a little bit more risk involved because some of the characteristics are political and social risk. And so, it's even taking a country like Turkey right now, and there's a lot of financial questions going on around Turkey right now. And so a lot of people who have been making investments in Turkey are, potentially worried because those investments are subject to that social risk and that political risk. And so as you invest in some of these countries that are less stable, there's a little bit higher risk on the political and social side. And then there's also a higher currency exchange risk. And so the value of these currencies can vary significantly more than the value of some more stable or developed market currencies. And so same idea with the British pound, but I think it's the Turkish lira, and there's a lot more variability going on in lira right now. And so as you move money in and out of these markets, you have to also deal with that risk. A part of why people invest here, though, is that you have the potential for high returns. And so you have potential high returns and you have potential for big losses. And so as you go down to the bottom of the screen, you can see, our developed markets, 4.64% expected return. So, a little bit higher than our domestic markets. Part of that is our currency, expected currency risk. And a part of that is potential room for growth as you invest in some of these different areas. Emerging markets, you expect even higher returns. If you're going to take on these additional risks, you expect a higher return. You expect that there's going to be some growth that can offset the risk, so that if you are taking losses in one area, you might be getting gains in a different area, and that higher return offsets the risk that you're taking. So it essentially gets us through our equities. And so you can see, right, the whole time we've been talking about this relationship between risk and return. So we invest in all these different types of equity to get a difference in expected risk and return profiles. Now, as we move into our fixed income category, a fixed income is less correlated to all four of those previous categories we've looked at. So it's less correlated to our stock return. And so we're hoping that by investing in the fixed income, we offset some of the risk by having a little bit more stability in the portfolio. So you see on the left here, we have domestic fixed income. And what we see just as a characteristic in general of fixed income is there's more price stability than stocks, because I know exactly the dollar amount I'm going to get my, let's just say $1,000. I'm going to get my $1,000 face value back at the end of this bond. The price doesn't move quite as much because I know that I'm going to get those coupons unless this company defaults, and I know I'm going to get $1,000. And so where the return on a stock or the cash that I receive from investing in a stock is unknown, the cash that I receive from investing in a bond is known. So there's less stability. We have that predictable cash flow. And so part of what in an OPEB or pension plan we might use fixed income for is asset liability matching, as I know that I'm going to have to be making benefit payments at a certain point in time. And so I'm going to make investments that line up in terms of time period with those benefit payments, so that when an investment matures, I then can pay my benefit payments with that investment. And that's what asset liability duration matching means, is that we can offset some of the risk in our pension plan and our OPEB plan by essentially taking on that risk in the bond portfolio, and those risks in theory even each other out. Moving over to the right, you see we have international equity. This is our international fixed income. This is the same idea. The only thing is you're going to be investing in international companies, international government debt. And so again, you're taking on currency exchange risk. And part of the characteristic of this asset or international fixed income asset is that you have a different debt cycle. And so the debt cycle is, interest rates go up and interest rates go down. And in different companies, those interest rates go up and down at different rates at different points in time. And so you're hoping to take advantage of a little bit of a different debt cycle. And so you can see, moving to the bottom, our fixed income has a relatively low expected return, but we're expecting stability in exchange for that return. And we're expecting to get some predictable cash flows in exchange for that return. And so we're going to get about 1% between these two asset classes. And that will let us sleep at night while the stock market goes up and the stock market goes down, and the bond market doesn't do quite as much of that. Next asset class, and this is one that really hot, gets in the news a lot, alternatives. There's a lot of different alternatives. So we'll just walk through these different categories of alternatives to start. So the first one there is commodities. Commodities would be owning physical materials, wood, gold, silver, oil, metals. So you're owning something that is needed to produce something else. And so the most common one that people might think of is gold. And you own gold to add diversification to try to offset some risks. And it's the same idea. Some people might own timber shares or shares of companies that mine gold or things like that to try to offset the risks of that end product. The value might change, but that initial input, the wood, its value is not going to change as much, or if it does, it might not be as correlated to the end product. That's the idea of commodities. Hedge funds are essentially an investment vehicle that allows sophisticated investors to almost do whatever they want these days. So hedge funds not only take long positions, so then not only do they buy stocks and hold them, but they can also sell short. And selling short essentially means that they sell something that they don't own. So they borrow a stock, sell it. They're hoping that the price goes down. They'll then buy it back at that lower price, give back the share that they bought at a lower price to the person they borrowed from. And that the difference, that price drop difference is what they earn in terms of a return. They can often also use leverage. So they can borrow money and take on debt to invest in more stocks, more equities. And so that increases the risk, and it also increases the potential return of the portfolio. One thing that's interesting about hedge funds is the cost structure tends to be what's called 2 and 20. And so 2 and 20 means that they earn 2%. So, you invest into a hedge fund, they're going to get a 2% return every single year. That's what they're going to, or they're going to get a 2% commission every year. So that's what you are going to pay to the hedge fund. And then they also take 20% of any gains that you get. So, if you have a year where you earned 10%, they're going to get an additional 2%. And so you might end up paying them 4% to manage your money for you. The idea of paying them that higher cost structure is that they're sophisticated investors and they're going to hopefully be able to get a better return for you. Another risk that you take on when you're working with hedge funds is liquidity risk. And so hedge funds can limit your liquidity. And if they don't want people taking money out, they can say you can only take out a certain percentage of your portfolio. And you can only do that quarterly, let's say. Like you can't take out all your money whenever you want. Not all of them do that, but they can. They can limit your ability to get liquidity. Limited liability partnerships. This is a business structure that a lot of people would use to invest in private investments. And so you can invest in an MLP as a master limited partnership. Is often used to build things that are related to the oil and gas industry. So you can invest in a master limited partnership, which would essentially let you be a private owner in let's say a gas pipeline that's moving gas from one place to another. You can, a general partnership might have a structure where I am a limited partner and I put money in. There's a general partner who then runs some kind of business on my behalf and I get returns for it. And so limited partnerships, help or can be a way to make private investments. A characteristic is that there's often lower liquidity. So if you buy into a limited partnership, you might not be able to buy out. There might be specified dates, and it might be that you have to leave your money there for 10 years. And if you try to get your money out, they might be able to say, nope, like, sorry, you said you were going to give us money for 10 years. And so, you do have a potential for limited liquidity. Private equity is kind of similar to a limited partnership, except for private equity. Well, first of all, it's only available to institutional investors, and it's going to tend to be a company that you invest in the company, and then the company makes private investments in other places. So rather than owning that private investment directly, essentially, you're investing in a company that then invests in other companies that are private companies. And so it's a way for investors to get access to private businesses that might not be listed on public stock markets. Another characteristic of this is, again, low liquidity. You might not be able to get your money out because those companies aren't publicly listed. And so you can't just sell shares of them whenever you want, or this private equity company can't just sell shares whenever they want. I also have listed here that it's only for institutional investors. And so, that means you have to have a high net worth, or you have to be a sophisticated investor. So pension funds, OPEB funds, are going to, by definition, be an institutional investor. So, we would be able to invest in those kind of things. So the last category we have is venture capital. Venture capital, some people consider it a kind of private equity. Some people don't. But essentially, venture capital is investing in private businesses, and they're trying to focus on startups. They're trying to focus on really small companies that have the potential to really blow up in value. And they might invest in 20 companies, and 18 of them might fail, but 2 might get really big and make up for all the losses that they made on all the other companies. And that's why we have the potential high returns and potential high losses. If they're making good bets, they can get a lot back. You can invest in Uber and get a huge amount of money back. But you could also invest in hundreds and thousands of companies that you and I have never heard of because they went belly up and they failed. And so you have that potential for high returns and high losses. Another characteristic that you see again here is low liquidity. Some of these companies can't get their money out of their investments they made easily. And so you as the investor can't get your money out easily. And so, summing all of that up, we just call all of those things alternatives. These are all alternative investments that you can make. And the expected return on our alternative investments is about 6%. So this is a higher level of return than we were expecting from all our various kinds of stocks. And this is, partially because we're opening up different markets for ourselves, but it's also partially because in addition to some of those other risks, in most of these categories, we've taken on liquidity risk. We can't necessarily get our money whenever we want it. And so if you're going to lock your money up, you need to make sure you're going to get a higher return on that money. The last category, or I suppose there's one more, and the last one's cash, but the last real category to talk about is real estate. And real estate can take a lot of different forms, and some pension funds will own real estate directly. And so they might own a rental property and directly own a commercial or industrial or even a residential property, and then they rent it out to people, or the pension fund rents it out to people. One of the advantages of real estate is that cash flows tend to be higher. So you make an investment, but then you tend to get cash out of that investment at a higher rate than you would get the cash out from other investments. They often are by definition lower liquidity investments. If you've made an investment into a building, you can't necessarily get your money out tomorrow. It's a process to try to find a buyer and to go through the legal process of actually getting a contract finished. And so there's lower liquidity. And then another risk that you end up taking on with the real estate market is that it's often leveraged. There's often debt that's taken on to make these investments. So that can increase returns, and it also can increase losses. A kind of easier way to get involved into real estate than rental property is REITs, and REIT stands for Real Estate Investment Trust. And so real estate investment trusts are a special investment vehicle that only invests in real estate, and they get special tax privileges. And as a part of that tax privilege, they have to distribute 90% of their profit to their shareholders. And so you expect essentially to invest in a big company that specializes in managing real estate. They're going to own, commercial buildings, they're going to own industrial buildings, they're going to own residential buildings, and then they're going to pay you a decent amount of the profit that they earn quarterly or monthly, whatever the distribution dates are for those different REITs. And it gives you some exposure to the real estate market, but you could also, because these are traded on the stock market, you could also get your money out tomorrow. You could say, I don't want to be invested in this trust anymore, and go and sell it. And for the most part, you can get your money out quickly. The last category in real estate is raw land. And so some towns might find themselves owning a piece of land for whatever reason. And some towns can move that into their OPEB portfolio or their pension portfolio and have that real estate. And essentially what you're looking for is, that appreciation that someday someone else might want to buy this piece of land. And so real estate, you can see we have an even higher expected rate of return. That's because this investment is not really available to everybody. And the cash that you expect to get out of real estate is a lot higher than other investments. And so you expect, again, if you take on that risk, you expect a little bit higher return. The last category to talk about is cash. So, cash just comes in several flavors, but savings accounts, checking accounts, treasury bills. Treasury bills are short-term government bonds, and also CDs. The thing to know, or the main characteristic of cash, is that there's no yield over inflation. So if you look at cash, it says 0, because we expect that it's just not going to earn anything above the rate of inflation. In fact, cash might lose money compared to inflation. So you have no expected return really, but you also have very little to no risk of loss. And so cash is safety. You also need cash if you're going to be making benefit payments. And so cash is the ability to make investments when the market is down. And so cash is often a strategic investment to be able to make benefit payments when you need, to be able to invest in other things when you need to. Most people aren't going to have all of their portfolio in cash, especially as that portfolio gets larger, because it really is not expected to get any kind of meaningful return. And so putting it all together, we end up back in the very same place we started. So how this asset allocation thing works is on this target allocation, we see a certain percentage that people have decided to put into all these different asset classes. You take this 20% times this 4.1%, add it to 35.25% times 4.55% all the way down to land at an expected real rate of return of 3.46%. We add back in our inflation, and we end up with a nominal return 5.96%, take out expenses 5.71%. So if someone had this mix of investments with the various diversification that comes with being invested in different asset allocations, the risks and returns that they're taking on, the ways that they're trying to offset risk with fixed income, this specific portfolio, we might expect over the long term something like 5.7% return on investment. So hopefully this has given you kind of a flavor of what these different investment classes are. Obviously, there's so much more that we can do talking about these different investment classes or asset allocations and how to choose different asset allocations. Hopefully you've gotten a little bit of a flavor, you've gotten a little bit of idea how we think about these things and how those things show up on your OPEB evaluation. I appreciate you spending some time with us today and joining us for this. Hopefully you learned something, you got something out of it. If you have any questions or comments, you want to get in touch with us, my email's here on the screen. You also have our phone number down on the bottom, and so you can give us a call. We would love to talk to you, answer any questions you have. If you have ideas of how we can make this presentation or your understanding any better, please let us know. We would love to hear from you. Appreciate you guys coming out today. I will see you on the next webinar, and maybe we'll see you on an OPEB or a pension valuation report and talk to you in person about your specific asset allocation. Thank you guys so much, and we'll be in touch.